Sense market commentary for the third week of December 2025, and indeed for the year as a whole, as this will be the last edition before we head off for the Christmas break. And we'll spend a little bit more time talking about the year as a whole, but last week was fairly calm to start with, and then things got a little bit more volatile. Gold up 2%, Nasdaq down by just over 2%, along with Japan. And that was, well, the proximate cause was the Fed's decision to ease rates, but also signal a fairly hawkish tone, and also signaling a lot of debate within the Fed committee. And it does seem that this exemplifies the uncertainty that we're facing going into 2026. But not huge moves, especially when you look at it in the context of the overall year, where you've seen gold up by more than 60%. You've seen emerging markets and global small companies, certainly outside of the US, up by about 30%. Now that's surprising because the general zeitgeist seems to have been that Nasdaq, Russell 2000 have really led the way, but that's because they've had such a dramatic recovery following Liberation Day. They were also the ones to be hit the hardest around Liberation Day, and throughout the year they've been fairly risky. And we've also got to remember that earlier on in the year we'd seen this rotation into ex-US stocks. It was seen as the end of US exceptionalism, and then we had Liberation Day, and ironically that seems to have brought a lot of fizz back into the US market, but still lagging some of those more sort of yieldy, under-owned parts of the market. So really a year of 4 quarters. We had the rotation trade early on, then we had Liberation Day, and then the most surprising thing has been that rebound in US assets. And this week we talk with Andrew Hunt, who has pretty much he's been pretty consistent throughout the last half of this year about how that's been driven by the unexpected capital inflows into the US, the unintended consequence of people front-ending tariffs, and increased uncertainty, bringing more capital into the US rather than less. And during that period, the AI theme has got stronger and stronger, bringing back that overall feeling of US exceptionalism coming to the fore again. But then in the last quarter of the year, we've seen doubts over that. It's undoubtedly that the US is leading the way in AI build-out and infrastructure, but there are a few doubts about how much they're spending, the return on investment of that, and whether that's going to be more effective than, for instance, China's approach, which has been more diversified, looking at EVs, battery tech, and there's some evidence that they're being able to extract more gains from AI in a much more energy efficient way, and fundamentally able to deliver effective AI at much cheaper costs. Now, the other thing about that chart, which really stands out if you're watching this and if you're not, what we see is bond yields down at the bottom, and most of the year, call it 3/4 of the year, the US 10-year yield and Australian 10-year yield moving in tandem, and you can guess which one is the dog and which one's the tail. But then recently we've seen this massive blowout in Australian yields, and there's a sense that Australian inflation is not as contained as it is in the US, and maybe there's a bit of a productivity problem. Certainly the RBA has taken immediate rate cuts off the table. And what you've seen is Australian equities actually lag throughout the year, and really especially in the last quarter. So really just up a little bit after some dividends. And that also tells a story of polarization, which we've seen across markets within emerging markets. It's Korea and Taiwan versus everything else. Within the US market, it's Mag 7 and AI tech versus the rest. And in Australia, it's been the so-called expensive defensives versus the fallen angels, the ex-quality stocks like Treasury Wine Estates, CSL, Ramsay Healthcare, all those which have been somewhat moribund. The suggestion is that it's been a very flow-driven market for different reasons in different markets, but retail in the US, external institutional investors washing back and forth with Europe and Japan, and within Australia, obviously the industry funds and also hedge funds creating some volatility. So flows and liquidity seem to be very important. Now, what this leads to is obviously what are we expecting next year? And one of the questions we got this from a client, but it's a recurring theme, is to what extent after 3 years of 20% or so returns, certainly from the S&P 500, when does the music stop? And in this table here, we've shown other years in the last 120 years when we've had those kind of returns for 3 years, and it begs the question, what happens next? Now, if we look at the chart and we overlay that with our expected return number, so just to remind listeners, this is a chart that shows what we think, using a relatively simple algorithm going backwards, what is the yield at a particular point in time, a normalized rate of growth, and what happens if you have a bit of mean reversion in not only earnings but also price multiples. So if things are very expensive, what happens when they become less expensive as sentiment wanes? And so what you can see is you get these dips around the late 30s. And during that period, and this is the main point about this chart, is there's a sense amongst fundamental investors that when you've had these sustained rallies, then something different is going to happen. Markets get more expensive, and they expect that actually the next year is going to be the one where you see a reversal. But the opposite happens, because what happens is you get this clustering, and it was famously summarized by the phrase from John Maynard Keynes back in the 30s when he'd witnessed this, and he was talking about a time when fundamental investors thought things were overcooked, and but markets just kept on going up. And what he said was the markets can stay irrational longer than investors can stay solvent. I've paraphrased that for the modern day equivalent. He might have said the market can stay exuberant longer than benchmark aware investors can stay in business. And that's the problem. We feel somewhat fortunate that we managed to keep up with markets despite being relatively defensive. But there's a lot of people around the traps, a lot of active managers wondering whether their sort of fundamental view of the world, given all these liquidity flows, is ever going to be proven right. Now, just to underline that, these red dots that you can see on the chart, and if you're listening to this, I'll try and explain it, is each red dot represents a 3-year period when markets have been above 10%. So call that a strong bull market. And you can see at the end of the 30s, we had 3 of those periods. So that's actually 5 years strung together. And markets just got more and more expensive, defying the fundamentals. Then we had a period just after with the relief rally in 1944, 1945, where we had sort of 2 consecutive periods, so that's 4 years. And then we had the sort of post-war reconstruction phase in the early 50s, similar thing. And then the next dot that we see is during the 70s. So we have at the end of the 60s, 3 very strong years, and then that grinding 70s, multiple recessions, etc., as risk premiums rise. And we got to the end of the 80s, and expected returns were very high. And then you have that long bull market, which culminated in the end of the 90s, and you get a similar situation to the end of the 30s, where you've got 3 years a bull market, and then people start, Greenspan was talking about irrational exuberance, and then you had another year and another year. So you have 5 consecutive years, and then you had the dot-com crash. And that takes us to the here and now, where we had around 21, we just had, despite COVID, we had 2019, 2020, 21, all well above 10%, 15 to 20% per annum. And then we had that setback in 22, and then we've had the last 3 years. And that brings us to the present and the question. We've just had 3 very strong years, a bad year before that, and then 3 before that. So that's 6 out of 7 of the last years have been exceptionally strong. So what gives? And when you look at that chart, it kind of tells a story that these things do cluster. There's a lot of liquidity swashing around. So as we turn our thoughts to 2026, and is this sustainable, or is it the time for a reversible? It's a salutary reminder that not necessarily. But when you look at the longer term, when risk premiums are so low, when multiples are so high, markets seem expensive, you don't really know whether it's going to be next year, but you do know that actually the odds of a setback at some point in the not so distant future, and the kind of one that unfortunately we'll remember, has probably increased. And that brings us to our What We're Working On segment with Andrew Hunt, where we talk about what's happened in the last year. And he also says that it's been very much liquidity driven, and that's one of the things that's kept us out of trouble. He kept on reminding us about the massive capital flows moving into the US, and why, even though valuations give you a certain picture, you don't want to stray too far from the benchmark, and perhaps not a hill to die on. And then we talk a little bit about his outlook looking forward. And basically, the punchline is it's too early to say. There are some times when it's time to have conviction, and there's some times where you've just got to keep watching markets. So even though it's the end of the year and we all want to make predictions, he's kind of saying, well, maybe we need to wait a few months. December 31st is just a date, and maybe we should wait a few months before making too many predictions about how sustainable this rally is. That said, we also talk about what you would do if you couldn't trade these markets, and it's very much a bias towards some kind of inflation and having inflation protection in your portfolios. Although, once more, this isn't advice, it's aimed at advisors, it's just information. And even though it's the end of the year and we're all tempted to make predictions, there's a lot of uncertainty out there, and we think the best course of action is just to diversify and maybe just be a little bit careful about the most expensive areas of the market. But like I said, not advice. And if you want to hear more, listen to our video this week. And for all our clients who are listening to this, we've also got a video segment where we talk to JT and our new managing partner, Cameron Spittle, where we introduce him, and he talks a little bit about the vision going forward and some of the things we'll be doing in 2026, building out the technology, building out some of our practice management capability. So if you want to hear a little bit more from Cameron, maybe tune into that video as well. Well, that's all for me. Look forward to talking again in the new year. Hope you have a fantastic break in the meantime, and a relaxing time with you and yours.